As of this moment, Monday, October 20, 2025, the U.S. stock market is in its pre-market session and is not yet open for regular trading. The figures you're seeing for Liberty Energy, ticker LBRT, represent the closing price from the last session on Friday, October 17, 2025. The stock finished that day at $15.32, which was a truly explosive move of $3.38, or 28.31% to the upside. Now, let's get right to the heart of this, because that 28% move is one of the most counterintuitive and fascinating market actions we've seen this quarter. The expectation, if you were just casually following the headlines, was for a bloodbath. The reality was a rocket launch. Here's what's really going on. On Thursday evening, Liberty reported its third quarter earnings, and by every conventional metric, the report was a disaster. They posted an adjusted net loss of 6 cents per share, which was significantly worse than the 1 cent loss analysts were bracing for. Revenue didn't just miss estimates, it came in at $947 million, a full 17% lower than the same period last year. Adjusted EBITDA, a key metric for operational performance, didn't just dip, it cratered, falling 48% year over year. Management themselves confirmed a slowdown in frac activity and serious pricing pressure. Before this report, major analysts had sell or strong sell ratings on this stock, and in the first few moments after that report dropped, anyone holding it in their Fidelity brokerage account or checking it on the Robinhood app likely felt a pit in their stomach. The expectation was that this stock was about to fall off a cliff. But it didn't. The exact opposite happened. The 28% surge on Friday was the market, in real time, violently rejecting the old narrative. This move signifies that investors, particularly large institutions, looked at that terrible backward-looking report, threw it in the trash, and focused on 3 specific forward-looking items that fundamentally reframed the entire company. The expectation was that LBRT is a cyclical, dumb oil and gas fracker. The new reality, which the market bought into with 27 million shares of volume, more than 5 times the daily average, is that LBRT is repositioning itself as a technology and power infrastructure company. Here is the reality that drove the 28% buying panic. First, despite the awful quarter, management raised the dividend by 13%. This is a massive signal of confidence. You do not increase your cash payout to shareholders if you believe you're in a death spiral. It was a clear message. Q3 was a cyclical trough, not a new normal, and our future cash flow is secure. Second, the commentary on their digi-technologies was incredibly strong. Management didn't just gloss over it, they highlighted that their digiPrime electric frac fleets are showing 30% lower maintenance costs and that their new AI-powered platform, Forge, is driving massive efficiency gains. The market is betting that as older, less efficient diesel fleets get retired across the industry, Liberty's high-tech, low-emission fleets will be the only ones left to command premium pricing. This is a technology story, not just a commodity story, something investors in Apple stock or Nvidia stock can appreciate. But the third and most significant driver, the one that likely had institutional desks at places using interactive brokers platforms scrambling, was the confirmation of their power business. Liberty announced it is securing over 1 gigawatt of power generation capacity to be delivered through 2027. They explicitly tied this to the growing structural power demand driven by AI computing, electrification, and industrial reshoring. This changes everything. The market is no longer viewing LBRT as just a service provider to drillers. It is now viewing LBRT as a direct play on the AI boom, a company that will build and provide the actual power that all those new data centers, the ones using NVIDIA stock GPUs, desperately need. To punctuate this, they appointed a new board member whose entire expertise is in power and grid transformation. The market's 28% surge was it realizing that LBRT might have just become a picks and shovels play for the entire AI build-out. This is why a traditional Schwab Intelligent Portfolios algorithm, which might be weighted to value or energy sector, would have completely missed this. This was a fundamental narrative shift. So let's talk about the trading action from Friday, because it was historic for this company. The stock didn't just gap up and fade. It opened high and kept climbing all day, closing near its absolute high of $15.65. This tells you it wasn't a short squeeze, though that was likely part of it. This was a full-on institutional reweighting. Funds that were short, betting on that bad earnings report, were annihilated. Funds that were underweight had to buy, and they had to buy at any price, chasing the stock all the way up. This is the kind of move that burns the old analyst reports and forces an entire sector reevaluation. Many investors doing self-investing on platforms like SoFi Invest might have been scared off by the initial 15% pre-market gap, but the institution saw it as a starting pistol. This is where online investing gets tricky. The headline numbers, the EPS miss, told you to sell, but the underlying text, the 1 gigawatt power business, told you to buy. This is a classic case of expectation versus reality, where the reality of the company's long-term strategy was so powerful it completely invalidated the reality of its short-term quarterly performance. For those who are just now looking at this company, let's be clear on what they used to be known for. Liberty Energy is, at its core, a North American hydraulic fracking company. They provide the crews, the sand, the chemicals, and the high-pressure pumps that break open shale rock to release oil and gas. This has always been an intensely cyclical, boom-and-bust business, heavily tied to the price of oil. For years, the investment thesis was simple. Oil high, LBRT good. Oil low, LBRT bad. That's why the stock has been so volatile. But their focus on building their own digiFrac electric fleets, which run on natural gas turbines instead of diesel, has been their key differentiator. The expectation was that this was a grain marketing gimmick. The reality, as shown by the new cost-saving data, is that it's a powerful economic advantage, and now it's the foundation for their investment help in a brand new power generation business. This is why looking at old performance on a Fidelity mobile app can be misleading. The company you are looking at today is not the same one it was 12 months ago. This brings up a critical question for the entire energy services sector. Liberty is making a huge, expensive bet on this new power business. Comment below, do you think Liberty's new AI power business is a real sustainable pivot, or is it just a buzzword-filled distraction from a weak fracking market? I'm very curious to see what you all think about this strategic leap. Looking forward, the path for LBRT from 1532 is now completely divorced from its old trading patterns. The stock is in discovery mode. The catalysts are no longer just the weekly rig count or the price of WTI crude. The new catalysts will be announcements of power purchase agreements, updates on that 1 gigawatt build-out, and any news related to AI data center partnerships. The online investing community will be watching this closely. The risk is, of course, execution. This is a massive new undertaking. If they fail to deliver this power business, or if the costs balloon, the market will punish this stock severely. The core fracking business is still weak, and they are using the cash flow from that to fund this new investing sites venture. This is not a set-it-and-forget-it stock for your Fidelity IRAs just yet. This is an active, high-stakes story. Traders on interactive brokers trading platforms will be modeling the potential value of this new power segment, and any analyst who doesn't update their model to include it is already obsolete. For the retail investor, this is a fascinating case study. If you were on SoFi Invest or Robinhood and just set a simple alert for the earnings, you would have seen the miss and concluded it was bad. It's only by understanding the why behind the market's reaction that the true picture emerges. This is where Fidelity Wealth Management and other advisory services try to add value, by looking past the noise. The 28% move wasn't about the quarter that was, it was about the decade that will be. It's a bet that LBRT is transforming from a cyclical energy stock into a secular growth story tied to AI. This is a much more compelling narrative than just oil prices are up, and it's why it's now being discussed in the same conversations as tech infrastructure, even if it's not a Tesla stock or Apple stock. It's providing a different but essential part of that new tech-driven economy. So, to wrap up,